Happy New Year. From all of us here at Wespath, we hope you've had a peaceful holiday season and a great start to 2023. My name is Joe Halwax, Managing Director of Wespath's Institutional Investment Services team. I am here at Wespath's offices in Glenview, Illinois, bringing you our fourth quarter 2022 Wespath update. What a historic year it was for the markets, with record fast interest rate hikes and rapidly changing inflation expectations. Ultimately, for many investors, it was a year to forget, marked by declines in both equity and fixed income markets. But on the other side of the coin, it is an opportunity for patient long-term investors. As we'll get into in today's update, 2022 could go down as a bump in the road that presented attractive valuations and a great chance to put cash to work. I'll offer more on that perspective in a market update shortly. You'll also hear a brief organizational update. Then my colleague Karen Manczko will preview the performance of our funds. Dave Zellner will provide an economic update, and Jake Barnett will cover our work in sustainable investments. We remind viewers that all these segments are available individually on our website. The fourth quarter was certainly busy for financial markets, but it provided many opportunities for thought leadership here at Wespath. Most recently, I provided an overview on the quarter's activity, as well as a 2022 year in review and look ahead to 2023. We'll be reviewing many of the points in that blog today, but check it out on the website if you're interested in the written format. Also, my colleague Karen recently wrote about the psychology of investors. Her piece is highly relevant for today, as it discusses how and why investors are tempted to deviate from their long-term strategies during periods of high volatility. I encourage you to read it, especially if you've been feeling those same temptations lately. As you've heard from us already, 2022 was a very difficult year for financial markets. Before we dive into why that was the case, I want to offer some positivity. It's now been 3 years since the onset of COVID. For myself, 2022 felt like the first real stretch of getting comfortable with the things that have changed and enjoying those things that have returned to normal. Think of events like weddings, birthday parties, or even a team bonding afternoon at Topgolf. Those things were missed, and it's good to have them back, even if financial markets didn't add to the celebration this year. Still, we start with more positives. Returns were in the green for both fixed income and equities in Q4, with gains largely coming in October and November. This positivity was seen after U.S. inflation data came in lower than expected in October, creating a growing belief amongst investors that inflation had peaked and that central banks would soon pivot to be less aggressive in their efforts to control inflation. Importantly, this reflects what we saw throughout most of 2022. Markets closely following every inflation report and Fed meeting, with volatile moves in asset prices occurring as expectations rapidly adjusted. As we can see in this slide, inflation expectations did peak in April and have steadily declined throughout the second half of the year. Looking now at equities in Q4, international stocks were very strong, with the MSCI EAFE index up a sharp 17.3% on the quarter. The MSCI Emerging Markets Index was also strong at plus 9.5% for the past 3 months. International markets have less of the mega-cap technology names than U.S. indexes, and those names like Facebook, Tesla, and Amazon were under pressure in 2022. Still, the S&P 500 closed the fourth quarter plus 7.5%, below international markets, but still a very positive quarter. Dave and I will discuss the volatility in the large cap sector later in our discussion. Before we move on to bonds, I want to show a chart of the US dollar to put in perspective the moves in international stocks. From January to October of 2022, the dollar rose 16% against a basket of foreign currencies, which is a very sharp move. Dollar strength was driven by the Fed raising rates earlier and faster than other global central banks. However, with inflation expectations seemingly peaking, the dollar fell 7.7% in the fourth quarter. Now let's turn to fixed income markets, starting with the yield curve. This chart shows the yield curve as it started in January, where it was at the midpoint in July, and finally where it stood at the end of the year. Obviously, we see that the yield curve is quite a bit higher than where we started 2022. And of course, it's inverted. You can see the beginning of the year at the bottom in blue, mid-year in green, and the end of the year at the top in orange. Let's think about what occurred throughout the year to cause this. The Federal Reserve raised rates 425 basis points in one of the sharpest moves in history. This was to address the much stronger than expected inflation. Remember, 1 year ago in December 2021, the futures market priced in rate hikes of 50 basis points for all of 2022. And as I mentioned, we ended the year with 425. While the Fed continued to hike in Q4, including 50 basis points in December, 10-year yields peaked in October near 4.2%. They closed the year down near 3.8% and were down to 3.6% by early January. This shift lower in the yield curve has been positive for bond returns. Indeed, the fourth quarter was strong as the Bloomberg U.S. Aggregate Index was up 1.9%, erasing some of the sharp losses seen in the first 3 quarters of 2022. Meanwhile, the Global Aggregate Bond Index was up 4.5% as foreign currency bonds benefited from the fall in the dollar. Looking at 2022 full-year returns, well, they are ugly. For stocks, we see weakness everywhere. The MSCI Emerging Markets Index down 20%, the S&P 500 was down 18%, and the EAFE Index down 14%. There are also some interesting style trends to note. Looking at growth versus value in the U.S., the S&P 500 Growth Index fell by 30% on the year, weighed by sharp losses in tech names like Google and Nvidia. Meanwhile, the S&P 500 Value Index fell just 7.4% in 2022. Investors last year favored companies with less growth but more predictable earnings, such as those in the energy sector, which was up over 60% on the year. This style trend does make sense. Growth names are less attractive when rates are higher. It begs the question, are we in a new era with higher inflation and higher rates? This is something we will continue to review in 2023. In fixed income, the Bloomberg Aggregate closed the year down 13%, marking the worst bond returns in 200 years. The volatility is really interesting to note for a couple of reasons. First, stocks and bonds rarely fall in tandem. These assets tend to be uncorrelated or negatively correlated, meaning they rarely move in the same direction. This is why 60-40 portfolios have been so popular historically, but last year, that correlation turned positive. Now that bond markets have quickly replaced inflation risks, we can expect a more stable yield curve and bond prices in 2023 versus 2022. This suggests that we will return to a more traditional neutral relationship with stocks. The other interesting thing to note here is valuations. If one has to find a silver lining in this bear market, it is that assets generally have fallen to more attractive levels based on historic metrics. Looking at global equities, this chart shows 5 major markets. The gray bar represents the 25-year average for PE ratios, the purple bar the 25-year average, and the blue diamond is current levels. U.S. stocks are near the 25-year averages after starting 2022 at very high levels. International stocks are all below 25-year averages, with Japan and Europe at very low levels. While calling the bottom to bear markets is a fool's errand, patient investors will see current levels as more attractive than a year ago, and cheap when looking at Europe and Japan. In fixed income, valuations are also fairly attractive versus their 10-year averages. This chart shows 12 fixed income sectors looking at yield to worst. Yield to worst is a measure of the lowest possible yield for a bond held to maturity without default. The dark blue diamond shows that in nearly every sector, current yields are high versus recent averages. This means bonds are again offering compelling yields and should offer ballast to a traditional balanced portfolio. Let me close now with a few thoughts. We've been through a rough year for investors, undoubtedly, but we've also learned a few things. It is likely that the market will now shift its focus from inflation, which should no longer be a surprise for investors, and the shift will be to growth, both economic and earnings growth, which we will continue to watch closely. Historically, years following bear markets are good for investors, and it's rare to see 2 negative years in a row. As noted earlier, bonds have been repriced and again are offering yield, and that should translate to ballast in a balanced portfolio. It is unlikely that the next decade will look like the previous decade, as leadership, particularly in stock sectors and frequently in countries, has always rotated. Wespath builds globally balanced and diversified portfolios that will allow investors to take advantage of the next market leaders and avoid the highs and lows of being overly concentrated. We continue to believe that investors should stay the course, remain invested, and focus on long-term results. I'm joined now by my colleague, Karen Manczko. Karen, thanks for being here today.
Thanks, Joe, and Happy New Year, everyone. It's great to be here today.
After a difficult market for many investors, how did the Wespath funds perform in the fourth quarter, and how did this affect the cumulative performance for 2022?
Since the last quarterly update, the markets re-entered positive territory and ended the quarter up, with international developed and U.S. mid-cap stocks posting double-digit gains. This was an encouraging turnaround after a very difficult year for both stock and bond markets. Looking back on the quarter, stocks ended strong in October, November, which was driven by U.S. inflation data coming in lower than anticipated. Following this news, investors were hopeful that central banks would curb the aggressive rate hikes experienced earlier this year. Unfortunately, the gains were short-lived, and we saw the U.S. equity prices fall in the month of December as central banks committed to continuing to increase rates to help moderate inflation. Interestingly, developed and international markets and emerging market stocks were both positive for the month, which were driven by China reopening after its lockdown and the inflation numbers in Europe improving. Fixed income also ended the quarter positive, which removed some of those sharp losses we saw in the prior quarters. You can see on the slide that both equities and fixed income ended the quarter in positive territory. The U.S. equity fund returned approximately 7% net of fees, and the international equity fund was up over 14%, outperforming its benchmark for the fourth quarter. The fixed income and the inflation protection funds both outperformed their respective benchmarks, net of all fees.
The fourth quarter was positive, but the full year was still quite negative for both bonds and stocks. Can you remind our viewers what drove the market volatility this year?
It has been a challenging year for equities and bonds. As highlighted in prior webinars, in the first quarter, it became apparent that inflation was no longer transitory or a temporary byproduct of attempts to rejuvenate the economy. After this realization, central banks geared up to fight inflation aggressively, meaning the era of low interest rates was effectively over. Supply chain woes were apparent in 2021 and became worse after the Russia invasion of Ukraine in February, which added unexpected geopolitical risk. Both equity and bond indexes posted negative returns for the first 3 quarters of 2022, which is extremely rare for markets, and both also posted double-digit losses. The equity funds were down over 19.5% and 21% year to date. The fixed income fund returns look similar, with the fixed income fund down 12.6% and the inflation protection fund down 5%. I'll spend a little bit more time on this when I review the contributors and detractors of the fund year-to-date performance in a moment.
Karen, we spent some time talking about 2022 markets and performance. How has Wespath's performance fared if we look past the 3 years, given the investment environment that we've been living in?
Well, referring to the markets as interesting the last 3 years is putting it mildly. If you look at the 5-year returns, looking past the last 3 years, 3 of the 4 funds that comprise the multiple asset fund outperformed their respective benchmarks net of fees, which led to the fund outperforming.
You showed us how the multiple asset fund fared relative to its benchmark. How does the fund look relative to other balanced funds?
This chart showcases the multiple asset fund versus a universe of balanced funds. This slide measures how our balanced fund performed relative to other balanced portfolios and funds that are currently on the market. We are using a universe that is compiled and maintained by Investment Metrics, which is a well-known reporting provider in the investment industry. Looking at the chart, you can see that the multiple asset fund has performed below the median for the 1-year time horizon, but performed in line for the median for the 3, 5, and 10-year time horizons. For the 10-year, the fund outperformed over 55% of other balanced funds in the universe.
Thanks, Karen. Moving on, can you tell us about the individual fund contributors and detractors for the funds this year?
Starting with the multiple asset fund, I highlighted this on the performance slide earlier, but the primary detractor to the fund's year-to-date performance was the underperformance by our international equity fund, which I'll talk a little bit more about in a moment.
You mentioned earlier that despite the markets being up in the fourth quarter, the gains were not enough to offset the losses experienced throughout the year. How did this impact the year-to-date performance of our funds?
That's correct. Starting with our U.S. equity fund, this fund outperformed its benchmark by 27 basis points year to date. The fund's underweight to large cap growth stocks, and particularly mega caps, contributed as we saw mega caps down 42% this year. Also, the fund's dedicated allocation to private equity and private real estate contributed. The primary detractor to the fund's performance was our overweight to small and mid-cap growth stocks, as growth stocks struggled this year due to the negative impact the rise in rates have had on this asset class. Also, the fund's active manager stock selection in information technology, communication services, and consumer discretionary. More specifically, e-commerce and cloud-based data management and security companies like Okta and Shopify, which were down 75% this year, had a negative impact on the fund's relative performance.
A lot of these tech names performed poorly in 2022. You just highlighted Okta and Shopify, two companies who saw phenomenal performance during the pandemic and really even before. What is the reason for the soft performance from these types of companies?
It's not only been a challenging market for stocks in general, but it's been a really challenging year for tech companies in particular. In 2020 and 2021, tech stocks were one of the best places to invest. 2022 was a different story, and this was one of the worst places to be invested. The interest rate hikes we've experienced have closed off these companies' access to easy capital. Also, the rise in inflation has made future profits of these companies less valuable today. Turning our attention to the International Equity Fund, the International Equity Fund's underperformance was driven by stock selection of our active managers, specifically in consumer discretionary and e-commerce. Also, the ethical exclusions was a modest detractor to the fund's performance. As a reminder, we believe our ethical exclusions neither help nor hurt the long-term performance of our funds. Lastly, a contribution to the fund's performance was its dedicated allocation to private equity.
I noticed a new slide that you've included that includes some comments that we've received from our equity managers.
Due to the challenges we've experienced, not only in the market environment, but also some challenges our managers have experienced in terms of stocks included in their portfolios, I wanted to spend a few moments and highlight the comments we've received from them. The themes we've heard across the board from them is that 1, the macroeconomic environment is what is driving market sentiment, and investors are not focusing on fundamentals, as portfolio company fundamentals continue to remain solid. Second, we also have managers that are taking advantage of this dislocation that is taking place and upgrading some of their positions with certain companies where the valuations are more attractive. The last point I'll make is that some of our investment managers are making modest shifts to their portfolios due to this market environment and reducing some of their tech exposure and increasing investments in industrials, materials, and energy.
It's always great to hear from our managers and learn the things that they're looking at and changes, if any, that they're making to take advantage of the equity valuations in the market. Moving on to fixed income performance. We commented earlier that equity markets are not the only markets that entered bear market territory. This has been one of the worst bond markets in history, with bonds displaying double-digit equity-like losses.
Yes, I said it before, and I'll say it again. The bond market was traditionally seen as a safe haven for investors when the stock market is volatile. But this asset class has not been able to hide from the volatility we've experienced. Despite negative absolute returns by our fixed income fund, it outperformed its benchmark by over 1 percentage points. There are a number of contributors that we have listed on the left side of the slide. And the primary reason for the outperformance was the fund's overweight to high yield bonds and the high yield bond manager Oaktree's issue selection. Along with the issue selection by our fund's Core Plus manager PIMCO, both Oaktree and PIMCO strategies have shorter duration than the benchmark, which has helped in this rising rate environment. Also, the fund's allocation to our internally managed positive social purpose lending program, which provides affordable housing and community development in disadvantaged areas, also contributed. The detractors for the year was the Core Plus manager's issue selection and the fund's allocation to emerging market debt.
Moving on to our final fund, the Inflation Protection Fund. It looks like this fund significantly outperformed the benchmark for the year.
The Inflation Protection Fund showcased its investment objective in 2022, since inflation has been and is an ongoing concern and could be for some time. As a reminder, this fund was created to protect investment portfolios against unanticipated inflation while providing a stream of income. It ended the year outperforming its benchmark by over 7.2 percentage points. One of the primary reasons for the outperformance is its allocation to floating rate senior secured loans, as well as the fund's allocation to an asset manager selection and emerging market inflation-linked bonds, as well as commodities. Also, relative to the fund's custom benchmark, the fund is underweight UK inflation-linked bonds, which was the most significant contributor to the fund performance.
Karen, UK inflation-linked bonds were down 33% in 2022, and therefore you just noted that the underweight was the largest contributor to our relative performance. Will Wespath continue to maintain this underweight to UK inflation-linked bonds?
It's a great question, and one that we have discussed internally among our investment team. One thing to note about UK inflation-linked bonds is that the duration is very long, almost 17 years of duration. Compare that to US TIPS with a duration of roughly 6 years. UK inflation-linked bond duration is over 2.5 times longer than that of US TIPS. The longer duration makes UK linkers more sensitive to interest rate increases, which is what happened in 2022, therefore making them more volatile. Interest rates in the UK increased during the year, not only due to the UK central banks working to control inflation, but also due to increased borrowing by the UK government. The asset manager that manages their global inflation-linked bond strategy in this fund can invest tactically in UK linkers. The manager's keeping a very close eye on the situation, and as of the time of this webinar, they have not added UK linkers to the strategy.
Thanks for the update, Karen. Are there any final thoughts?
As I conclude my portion of the webinar, I wanted to let our viewers know that we continue to actively engage our external asset managers daily regarding the markets and their portfolios. We continue to have conviction in our fund's diversifying allocations, and we have not made any major adjustments or shifts to the fund's allocations. We have confidence in the managers that we have selected and hired to manage the assets on behalf of our investors. As I mentioned earlier, our managers continue to closely monitor the markets and the macroeconomic events and have used this unusual environment to make modest adjustments to their portfolio now that valuations have come down and are more attractive. They also continue to monitor the underlying fundamentals of the companies they invest in and will make adjustments as needed. Oftentimes, when investors feel down and stressed about the markets, they tend to be reactive and sell risk assets such as equities. As you've heard us say time and time again, trying to time the markets is a difficult task and can lead to mistakes in investment portfolios. As long-term investors, we don't chase returns. We remain disciplined to our process, our strategies, and allocations. Our best interest is our clients' best interest, and we are here to work with our clients to ensure that we are continuing to invest on their behalf in a way that allows them to meet their long-term financial goals and support the mission of their organization.
Thanks for that update, Karen. Dave, thanks for joining our quarterly webinar. After such a tumultuous year in the markets and economy, I know our viewers will be interested in hearing your thoughts for what's ahead in 2023.
Thanks, Joe. I always look forward to sharing my thoughts with our participants and institutional clients.
So we should probably start what's currently on the mind of investors, and that's inflation. As you know, the Federal Reserve Chair Jerome Powell and other Fed governors have been very public regarding their resolve to get inflation under control. Investors worry that continued aggressive Fed action will derail economic growth and cause a recession. What stands out most to you in terms of the inflation reports we've seen over the past several months?
You're right, Joe. Each month, investors anxiously pore over the inflation numbers and attempt to guess what the Fed's next move might be. We're filming this webinar on Thursday, January 12th, and earlier this morning, the Department of Labor released inflation figures for December. It's fair to say that investors expressed a sigh of relief as the annual rate of inflation continued to ease and was exactly in line with what economists were expecting. This first chart, Joe, shows the path of inflation over the last couple of years. As you know, the 9.1% annual inflation reading back in June was the highest rate of inflation in 40 years. And while we should all be glad that inflation is easing, we still have a ways to go before the rate of inflation reaches a more sustainable level. So let's start with the good news from this morning's inflation report. Energy prices continue to ease, with prices down a bit over 6% for the month of December. If we were to look back at the June inflation report, Joe, we would have seen that the increase in energy prices accounted for 3 percentage points, or 1/3 of that 9% inflation that we saw for the month. Now, keep in mind that energy only accounts for 8% of the consumer basket of goods and services used for measuring inflation. In today's report, year-over-year energy inflation accounts for a little more than just 1/2 of a percentage point of December's 6.5% inflation. Additionally, we also saw price declines in used cars and airfares. So it's fair to say, Joe, that the factors that originally drove inflation have certainly eased. But if we look at this next slide, we can see that food and shelter inflation, the two categories that together make up well over half of the consumer basket, remain stubbornly high, with housing expenses continuing to move higher. Transportation costs, however, continue to decline.
So Dave, then how do you think inflation will play out in 2023 and beyond, and what will you be watching for?
So the short answer, Joe, is that I think the annual rate of inflation will continue to come down, but how far it will fall is anyone's guess. There are a lot of factors at play that will influence inflation over the next couple of years. Candidly, I struggle weighing the influence of these many varied factors. But let's first look at what consumers and the markets think. The chart on the left side of this next slide shows the path of consumer expectations based on a survey conducted by the University of Michigan. Consumers typically overestimate future inflation. Expectations for inflation over the next 5 years have hovered around 3%, so let's perhaps think we view that as a ceiling. On the right, we see the path of the 5-year break-even inflation rate based on the difference in interest yields for a traditional 5-year U.S. Treasury note and a 5-year Treasury inflation-protected security. This difference represents the market's view on what inflation will be on average over the next 5 years. Expectations peaked at about 3.5% back in March and declined quite significantly to 2.25% today. The bottom of this slide shows that the market also thinks that inflation will average 2.25% over the next 30 years. We've definitely seen positive signs that inflation will continue to decline into 2023 and beyond. Recall the supply chain issues that disrupted the economy for much of the last 2 years. Those have been largely resolved. When the supply of goods matches the demand for goods, pricing pressure eases. We've also seen a significant drop in housing activity, largely due to an increase in mortgage interest rates resulting from the Fed's aggressive action to address inflation. At the beginning of 2022, the average 30-year mortgage stood at a tad above 3%. Rates peaked at just above 7% back in November, but still hover around 6.5% today. The average price of a home in the U.S. today is about $350,000. So assuming that one were to finance 80% of the cost with a mortgage, a homeowner would be paying about $500 more a month today than they would have just a year ago. A drop in housing activity means fewer purchases one makes when switching houses, lower demand for renovations, appliances, etc., has disinflationary effects. So while that may not be good for economic growth, it should ease inflationary pressures. We've also heard a lot recently about low personal savings rates and consumers depleting their savings built during the pandemic. In addition, consumers have added to their debt burdens and have increased the use of credit in paying for goods and services. So as we enter 2023, it's reasonable to assume that consumers will have cut back on purchases, which again could have disinflationary effects.
So Dave, I want to pause here real quick because what you're describing, a drop in housing and reduced consumer demand, it certainly sounds like the beginning of stagnant economic growth or even a recession. A lot of economists think the U.S. has already entered a recession. So is that what you're seeing, Dave?
So let's look where the economy stands at the end of 2022, Joe. As you know, the economy contracted in the first half of the year, declining 1.6% in the first quarter and 0.6 in the second quarter. We had a rebound in the third quarter with a growth rate of 3.2%. Now, this next slide displays the Atlanta Federal Reserve's most recent forecast for the fourth quarter, which shows 4.1% growth. If accurate, that would mean that the economy grew at around 2% in 2022, which would make it pretty much an average year in the 21st century. But if you look at the chart on the right, you can see the evolution of 2023 GDP forecasts of economists surveyed by the Wall Street Journal. Not great news. The consensus seems to be that we will have a mild recession this year and then revert to about average growth in 2024. Earlier this week, the World Bank revised its 2023 growth forecast for the world and the U.S. Because of the inflation we experienced around the world last year, it lowered its growth forecast for the world to 1.7% compared to its forecast of just 6 months ago for 3% growth. It sees the U.S. growing at a meager 0.5% this year. But it's important that I emphasize, Joe, that this view is widely known by the market. So for those watching that think the 2023 economic forecast will be bad for the markets, I must emphasize that the markets are forward-looking. We should assume that current stock prices reflect an expectation of near zero growth in 2023. If conditions worsen relative to expectations, then markets will likely suffer. If the economy performs better than expected, then stocks should rise absent more interest rate shocks. I do think that the data today seems to support the view that we are in for a couple of rough months to open 2023. This next slide looks at the results of purchasing manager surveys for manufacturing and service companies. Each month, the Institute of Supply Management asks companies if their business is better or worse than the prior month. Activity in both manufacturing and the services sectors have been in precipitous declines. So it's fair to say, Joe, that the business sector is facing a rough patch over the next several months. And as you can see on the next slide, corporate profits are certainly going to suffer. Analysts see a decline in corporate profits for the fourth quarter of 2022 and again in the second quarter of this year, with just a very modest increase for the first quarter. They don't see decent profit growth again until the second half of this year. But again, Joe, remember, the market knows this, and stock prices reflect this information. The extent to which expectations change is what will influence future stock price movements.
So Dave, then what could potentially have a positive influence on economic activity in 2023? What will you be looking for there?
Certainly, as we've talked about, the key issue in the U.S. is going to be the path of inflation and the extent to which the Federal Reserve is satisfied that its inflation is under control. But there are a couple of international wild cards at play that I do believe could positively influence the U.S. economy. The first, of course, is the war in Ukraine. The war has negatively affected Europe, notably due to higher energy prices. Europe is currently experiencing a mild winter, and energy prices have come down a lot, so that's a positive. But until we see an end of the war, Europe is likely facing stagnant economic growth. An end of the war would certainly improve economic conditions in Europe. But I think an even bigger wild card is the economic implication of China's 180 on its COVID restrictions. China effectively lifted all restrictions and fully opened its economy on January 8th. While the Chinese are in for a rough few months, as COVID continues to spread rapidly across the country, we could see a massive resurgence in demand for goods and services by Chinese consumers later in the year, similar to what we saw in the U.S. when we lifted restrictions in 2021. That would likely have positive knock-on effects for the U.S. economy. though in fairness, it could also contribute to increasing near-term inflationary pressures.
Thanks, Dave. I agree. The economy could be in for a rough patch for the next couple of months. It'll be certainly interesting to see what transpires over the quarter. Is there anything else that you'd like to share with our viewers?
Yeah, thanks, Joe. There's one more topic I'd like to discuss, and that's the performance of the 7 mega-cap tech companies in 2022. My last slide shows the extent of the carnage impacting these companies in 2022. I've listed here the 7 largest companies in terms of market value at the end of 2021 and the losses in market value experienced by each. Our viewers will recognize most of the names in the list. Alphabet is the parent of Google. Meta is the corporate name for Facebook. NVIDIA is a diversified technology company with a heavy emphasis on artificial intelligence. As our viewers can see on the slide, all these companies saw precipitous declines in their stock prices in 2022. While the rankings of the top 4 did not change, Tesla, Meta, and NVIDIA all dropped out of the top 10. The combined loss in market value for these 7 companies was nearly $5 trillion. Now, to put that in perspective, $5 trillion exceeds the market value of the entire German and Japanese stock markets combined. It also exceeds the market value of the entire U.S. energy and retail sectors combined. The losses are just staggering.
I agree, Dave. The $5 trillion is just a huge number. So we know that Wespath has intentionally underweighted these mega cap names. Is now the time to jump back in?
I don't think so, Joe. Even though these companies saw big losses in 2022, the stocks still aren't cheap. Technology continues to evolve rapidly, and I cannot confidently predict that these same companies will be leading the way 10, 20, 30 years from now. So, Joe, you posted a great graphic earlier this week on our internal Teams channel that showed the largest stocks at the beginning of each decade over the last 100 years. Some notable, or should I say forgettable, names that appeared on the list were Sears, Kodak, Lucent, and Time Warner. And we don't see those anywhere near the top 10 anymore. I think that our stakeholders will be better served by investing in the up-and-comers, those companies with new and exciting technologies that offer great opportunities for meaningful price appreciation.
Thanks for the update, Dave. Always great speaking with you. I'm joined now by Jake Barnett from the Wespath Sustainable Investment Stewardship team. Jake, welcome.
Happy to be here.
So Jake, you and other members of the SIS department got a chance to see a number of long-term collaborators and peers in the fourth quarter. Can you share some of the places that you visited and how each location connected to your work at Wespath?
Sure, Joe. Happy to. I spent much of the month of November on the road, starting with attending the Conference of Party, or COP, climate talks in Egypt. At COP, I was representing Wespath alongside other agency partners. John Hill from Church and Society and Jenny Phillips from Global Ministries were there with me in person the first week, and then Ilka Vega from United Women in Faith also attended the second week of the conference. After that, I went to Munich, where I met Patrick Para, a long-term collaborator with whom I co-lead the engagement track of the Net Zero Asset Owner Alliance. I then went the following week to London to meet with multiple asset managers of Wespath and faith-based collaborators, including UK counterparts from the Central Finance Board of the Methodist Church. I finished my work tour across the Atlantic with a visit to PRI in person in Barcelona. My colleague Ryan McQueenie also attended and spoke on a panel at the Responsible Investor Conference in New York. There wasn't quite enough room on the slide to fit that too.
And so Jake, what were the main takeaways from seeing so many of our strategic partners in person?
So at a high level, I would say one of the most valuable parts of this trip was deepening relationships with so many close collaborators. I started at Wespath about 3 years ago in January of 2020. So my first couple of years on the job were almost entirely virtual collaboration. We were able to get a lot of meaningful work done in this time. For example, Patrick and I wrote our flagship paper, The Future of Investor Engagement, without ever having met one another. However, this trip really reinforced the value of personal connection and in-person collaboration as a crucial means of building trust and generating new ideas.
And so, Jake, so what were some of the specifics of each trip that stuck out for you?
Moving in chronological order, at COP, it was enlightening to witness in person some of the competing different priorities of stakeholders when it comes to climate action. For example, it was powerful to hear the compelling moral case being made by Pakistan, which had just experienced devastating flooding earlier that year. The Pakistani representatives shared how the impacts of these events would not be confined to their country, including a slogan, "What happens in Pakistan doesn't stay in Pakistan." Long-term attendees of COP also talked about how developed markets like the US would have little credibility as negotiators when asking emerging markets countries to wean off fossil fuels without fulfilling their own commitments to provide climate finance, which in the UN context is providing funding to help with adaptation and mitigation in emerging markets. However, in sitting in a session with US negotiators, it became clear how complex it is to fulfill these commitments. Funding climate finance in the UN context is the remit of Congress, and Congress doesn't currently have support for such budgetary line items, especially given potential recession fears and bipartisan gridlock. Despite this gridlock, one clear point I heard in another private session was the need for clear signals and policies from government that would enable and build momentum for climate action within the financial sector. All of this complexity made me grateful to be attending this conference with colleagues John and Jenny. The ability to hear their nuanced perspectives and to debrief the days with them was certainly a highlight of the conference for me. You can find recordings of 2 webinars where we shared perspectives alongside Ilka Vega on the Wespath website in terms of our experiences at COP.
And Jason, what about the next couple of weeks in Europe?
Next, I went to Munich to spend time working in person with the aforementioned Patrick Para. My time with Patrick was primarily spent planning for the year ahead, so I will leave updates on any projects there until we get them a little bit further along. Next was a trip to London, where I met with 3 of Wespath's asset managers based in the UK, Schroders, Baillie Gifford, and Mondrian. I also met with a number of long-term collaborators, with special thanks to partners from Church of England, Adam Matthews and Stephen Barry, who treated me to a traditional Thanksgiving dinner consisting of delicious Italian in downtown London. The last stop in London was attending the World Energy Capital Assembly, convening of leaders from the oil and gas and investor communities. Patrick and I were invited to speak to a panel of executives about the ideas contained in the future of investor engagement. And it was great to address this non-traditional, non-sustainable, investment-oriented audience. One enlightening reoccurring theme that was shared by members of the oil and gas community was a recognition that many of the headwinds of further investment in oil and gas were due to traditional financial concerns from investors rather than climate concerns, just reinforcing that investors remain concerned most often primarily about the bottom line. Finally, I ended up attending the conference of one of Wespath's key strategic partners, the UN Principles for Responsible Investment. After starting from relatively humble beginnings of just a few signatories, including Wespath, PRI now represents over 5,000 signatories managing or advising on over $100 trillion in assets. However, with this big tent comes the difficulty of serving the needs of the diverse community. As a panel speaker and in hallway discussions, I encouraged PRI to continue to lift up asset owner voices when it comes to engaging our managers to align interests in terms of long-term systemic economic health. PRI established a working group on this topic after the conference, so hopefully we'll have more to share on that soon.
And Jake, it wasn't just you traveling from your team in Q4, was it?
No, it wasn't. My colleague Ryan McQueenie also attended the Responsible Investor Conference in New York, where he spoke on a panel. You can see a debrief from Ryan on Wespath's social media platforms about that conference experience, but key sentiments expressed included gratitude for meeting people in person and a reaffirmation of Wespath's status as a sustainable investment leader. And that concludes our Q4 travel.
So Jake, thanks for joining me today, and thanks for the update on your journey.
Happy to do so.
Thank you for attending the fourth quarter Wespath webinar. If you have any questions, please send them to investmentinfo@wespath.org. See you next quarter.